Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, good to see you.
Always good to be here.
All right. Tisa, how are you?
Doing good. Good morning, everyone.
Hey, good. And we're missing Bruno, which is a shame. We had to sort of move this show around a little bit, but Bruno had spotted a terrific report by a previous guest on our show, actually almost now a recurring guest, Mr. Jason Fichtner. Jason, welcome to our show. And you are the chief economist and bipartisan policy center and executive director for the Retirement Income Institute. Did I get the title correct?
Yes, I have many hats. So I'm the chief economist of the Bipartisan Policy Center, which is a think tank in Washington, D.C. And quick fun fact, it is the only organization registered in the District of Columbia with the word bipartisan in its official name. Now, I'm not sure whether that's a supply or demand problem as an economist, but it does tell you about Washington, D.C. these days. And then, as you mentioned, I'm also the executive director of the Retirement Income Institute for the Alliance for Lifetime Income. And that's where we work on a lot of issues that's of interest to you on retirement security and protected income strategies. And just because I hate to have not just one job or two, but I got to have three, I'm also on something interesting which came out of the bankruptcy of Puerto Rico called the Puerto Rico Pension Reserve Trust. And it is a very unique organization that's independent from the government, but it's designed to actually be a pension trust to help pay future benefits of Puerto Rico. And there's a board and a council, and I chair the board, which manages the investment money for the pension.
Fascinating. Well, we steer clear of politics, but, I listened to the State of the Union last night, and if that's any indication of what we'll be talking about for the next 10 months, 12, 11 months, we're going to be talking, Jason, a lot about Social Security. How do we pay for drugs? How do we deal with inflation for seniors? So, the topic is clearly in the news. But we want to talk about your study. But before we get into that, you kind of tell us, what have you been up to in the last, I don't know, Ramsey, was 6 months ago, 12 months ago? When did we have Jason on last? I'm trying
Probably.
to remember.
I had the pleasure of being on a panel that Jason moderated at the Alliance for Lifetime Income's annual event last May. So thank you, Jason, for inviting me to that. I will say that I made the mistake of making an editorial comment about the Social Security system, and Jason said, "Wait a minute." I was there, and it was not just there, but was involved in key decision making. So really great to have you back, Jason. You have, what you do and what you've done have never been more relevant.
I appreciate that. Thank you. And that's kind of a good segue, I guess, into what I've been working on, because with the Alliance on Ramsey, you were on that panel at our summit here in DC, and the last several months been working a lot on the retirement income challenge. And I think it's important we have this kind of discussion because there are some folks out there saying there's a crisis. There are others saying there's not a crisis. And I think instead of trying to get hung up on whether there's a crisis or not, I think we all can agree that there's a retirement challenge going on. And for some people, they're probably well set and can be fine retirement. But for others, they're going to struggle. And there's a big number of people in the middle who are really confused about how to take their, say, 401k assets and how to turn that into a stream of income which they can use in retirement to be safe and secure, make sure it lasts their lifetime and not run out of money. And some people spend too much, some spend too little. And this leads into the paper you mentioned, Paul, which I've done recently, which came out in January. And it's the peak 65 moment. And so we're talking about peak 65 and the retirement income challenge. And why we're calling it peak 65, what that means is starting this year in 2024 and continuing through 2027. But starting this year, we now have 4.1 million Americans turning 65 every year. That's 11,200 a day on average. And what that means is the tail end of the baby boomers are now reaching their peak 65 moment and reaching the age of retirement. By 2030, all the boomers will be 65 or older. This creates that silver tsunami we've been talking about for several years. It's now here. And when we think about what that means from a retirement challenge, we're getting to the point where in 2031, the Medicare Trust Fund is projected to be insolvent. In 2033, the Social Security Retirement Trust Fund is scheduled to be insolvent. That does not mean bankrupt. It just means depleted, which means we won't have enough to pay full benefits. And if you include the Disability Trust Fund, then we get to 2034, where both trust funds will be insolvent. So within the next 10 years, we have this window to make a big difference that we have to make, but we don't have 10 years. 10 years is when the final trust fund becomes depleted, but policy takes a long time to implement. So we got to start making changes now. And that's why this paper is so relevant, because we're talking about how the environment has changed from a traditional defined benefit pension plan, which our parents or our grandparents had, and they had a paycheck at work and then a paycheck when they retired. And then for Tisa's father, he's got a pension from when he worked in the government. I've got a partial pension, but not a big one. So most of my assets going to be in a 401k style plan. That has changed to a defined contribution environment where people now save through their employer and through themselves with an employer plan. They get retirement with an asset, and we say, have fun, go out, and they have no idea how to take that asset base and convert it into a paycheck in retirement.
And Tisa, maybe just give a little backstory. You've got sort of family connections. Not only you're working with us and on the same issue, but this is a legacy for you. I didn't even realize this till we started the show.
Yeah, I mean, it's not something that I realized would connect into my career as a child by any means, or even as a young adult. But my father had a 40-year career with the Social Security Administration. He started in almost a manager position running a call center, and worked his way up to a regional commissioner. So I remember going to functions and his offices and his retirement party, and meeting all of his friends over the years. To your point, Jason, he did retire from the government, so we had the benefits of a fairly decent and large pension and some other retirement assets that were built up. So he's maybe on a different the different spectrum of saving, and he was actually a saver and very frugal, which frustrated my mom over the years. I remember a few shopping trips where there were some arguments, but yeah. So the problem's real, right? That's a structure that's gone away for the most part. Outside of working for government or state agencies, most of us working for private or corporate sector, have to take on that, I'll say, challenge, to use your word, of saving on our own and then having some advice, whether it's an advisor or a peer group that is helping us understand what to do with that large asset to create that income stream. So I'm restating a little bit of what you said around the challenge, but and I haven't had the benefit of reading your study, but what is your study saying? What are some of the things that you're recommending that
So this is a
retirees
really good
start doing?
segue, Tisa. So I'm glad you brought it up because, again, I was the principal deputy commissioner and chief economist at the Social Security Administration, where I served basically 2 years under President Bush and 2 years under President Obama. And one of the biggest things we did when I was there, besides a research function helping get the disability program, the backlog down, was work on the retirement challenge about people when they claim Social Security. And so, as this is called that annuity show, and Social Security is an annuity. So for people out there who say we don't like annuities, but you love Social Security is an annuity. That's the idea behind it. It's the old age survivors insurance and disability program, and it's an annuity. And what we were finding is that people were claiming Social Security retirement benefits at 62. And a lot of them didn't understand that was actually the minimum monthly benefit amount. And that for each year you delay past 62 up to 70, you get roughly an 8% return. And that the difference between the age 62 monthly amount and the age 70 monthly amount is about a 77% increase. And they just didn't understand that. A lot of people don't understand the benefit challenges and the benefit formula. So we were trying to help people understand this as a personal decision, but you need to be fully informed about it. And one of the things that the research study says is that we look at the traditional, remember the three-legged stool for retirement? It was Social Security, your employer pension, and personal savings. That made a three-legged stool, which was supposed to have stability in retirement. Now you get to the point where people don't have that pension anymore. They're having a hard time savings. And any personal savings is basically trying to go into, maybe a retirement account through your employer. So those two legs are together. Social Security's got some financial problems. So at point, it looks like a two-legged stool or a pogo stick. And what we're trying to do now is talk holistically about the value of protected income, which of course includes annuities and Social Security. And one of the things we talk about is how do we take some of that defined contribution-based assets and convert that into a stream of income in retirement that's protected. And that does not mean, again, we've talked before the show started about there's more products out there. I'm an economist. I love competition. I think competition drives innovation. It helps choice. It means there are more products, more people that can fit their needs. But there's one thing we talk about in the paper, it's something that I call a bridge annuity. So think about somebody who's retiring or wants to stop working, whether it's age 62, 3, 4, 5, whatever that age is. And they go into their employer and say, I'm retiring, give me my money. And say, okay, you got a 401k, here's your pile of money. And they say, what do I do with it? Well, one of the things we could do is maybe offer in the plan a bridge annuity, something that says we're not giving you an annuity for life, but we're giving you something. If you're 62, we'll give you a 5-year fixed term annuity that gets you to 67, which will be designed to basically mimic your age 62 Social Security benefit, so that you get that monthly income. Then you turn 67, that income from the annuity turns off, and then you turn on Social Security and get a higher monthly benefit that's inflation protected for the rest of your life. So one of the paper calls out is how we now start thinking about holistically protected income retirement with annuities, with Social Security, and more so talking about the challenges that people have when they get to retirement and how they have to convert that income stream that they get into an income stream from that defined contribution plan asset base. A lot of people don't know what to do with it. They're scared, they're afraid of running out of money, and we need to have a better conversation about what they can do and how they can do that.
Yeah. Well, you know when it's interesting. When Bruno set this up, he was excited about the paper, but Jason, this is like so near and dear to our hearts, and again, our attempt here is not to do commercial for our company or for products, but historically, NASA and our predecessor company really had a niche in that early income space for people who are trying to solve exactly that same problem. So, we've had a product for a number of years that has relatively high early income. So a lot of these annuities are sort of designed for buy the product, hold for 10. And ironically, the product has kind of carved a niche for us with federal employees who can retire at 58. And in a lot of instances, how would that be? We just came out with a new product in that space. I won't go into it, but here, but it really is trying to figure out how do you close that gap? Now, I will tell you, talking to a lot of agents, talking to a lot of distributors, Jason, people have a really hard time just figuring out how to optimize these numbers. And it's interesting, right? You say, well, let's see, I take money. Do I want to take the smaller check but have it for more years, or wait till 70 and get a bigger check but for fewer years? What do I want? Now, you should, I think, tell me, Jason, a rational person should say, how long do you think I'm going to live? Am I healthy? Am I not healthy? I think the break-even point seems to be around like 83 or 84. If you're going to live past 83 or 84, it probably makes sense to delay. What's so hard about this calculation that people have to do?
So here, I'm glad you brought this up, Paul. So one of the things that I think financial advisors and financial professionals, let's make it a broader tent, financial professionals in general, whether you're an accountant, advisor, a plan specialist, a lot of times they focus on like, how do you maximize your Social Security benefits and your Social Security wealth, and use the idea of the break-even analysis. And when I got to Social Security, we literally were telling people, when we had claims representatives in field offices, they'd come in, they'd say, because the biggest question we get at Social Security was, when should I retire, right? And again, do you know when you're going to die?
Yeah.
If you know when you're going to die, I can help you plan your life really well, but we don't know when that's going to happen, right? So what ends up going on is people are walking into the field offices and they were 62, and Social Security would say to them, if you take benefits today at 62, you'll be ahead for 14 years, right? So at that point, it was basically 76 was the break even. And people go, oh, I'll be ahead for 14 years. Sign me up. What the agency didn't do is say, if you live past those 14 years, you're then going to be behind for the rest of your life, when you might need that income at a higher monthly value, when you have other health challenges or other income streams deplete. So we were doing a disservice. So the idea was to change the narrative, talk about a personal benefit, because everyone's different, right? Someone could come in at 62 and have a terminal illness. Someone could come in and be in good health. They might need it longer. So what I try to help people say is, don't think about Social Security as wealth and how to maximize your Social Security wealth. think about how you can maximize the insurance value of Social Security and minimize your risks in retirement. And that's what we need to talk about holistically about retirement, which includes Social Security, if you have a pension or if you've got a defined contribution plan, how you can maximize those together to minimize risk. And the one thing that I love about annuities, and again, I'm not being product specific, just annuities in general, is it's that guaranteed protected income strategy. And so when you go in and talk to somebody, what they're really fearful about is even if they have a large savings asset base, they're afraid they're going to run out of money. And so they don't have what like David Blanchett and Michael Finko, who've been on your show, call a license to spend. Right? When we work, we get a paycheck. That paycheck becomes what economists call budget constraint. You get $1,000 a week, you get $2,000, whatever the number is, you know that out of that, you've got to pay your rent, you've got to pay your mortgage, you've got travel, you've got food, whatever it is, that's your budget constraint. Then you get to retirement and you no longer have that paycheck. That's what a defined pension benefit used to do, is give you that paycheck, that security, and you knew what to spend. Now we've got to convert that income stream from your defined contribution asset base, along with Social Security. So this gets back to your question, Paul. When should you claim benefits? It's a personal decision, but I would hate to have someone say, "Look, you can if you do it today and you get to this age, you've maximized it." Think about the insurance value. How much income do you need that you want that needs to be protected and guaranteed, both from an annuity and Social Security, and then figure out what the right claiming age is for you.
So Jason, I just have a sort of a thought and a comment, and everything you said is like, obviously so on point. People naturally came to the Social Security Administration to answer those questions because that's where the money was coming from, and many of those people probably didn't know where else to go. To not just one, ask the question, and two, sort of work their way through the calculation. I guess my question is what kept the Social Security Administration, or keeps them to this day, from providing more prescriptive advice? And and then beyond that, like, how can the private sector reasonably get there? Because I don't feel like it's knowledge that's widespread enough, even though it's not new.
Yeah, so the agency does have, there's a great, you can just Google it. So anyone who's listening wants to Google, just Google when to start receiving Social Security retirement benefits. That phrase will bring up a 2-pager, a double-sided 1-pager from Social Security that sort of walks through the questions you should ask yourself. Are you in good health? Do you have an outside income? Mm-hmm. Think about if you have a spouse or not, because spousal benefits are also dependent on when you claim Social Security. Make sure either way that you sign up for Medicare at 65, because that's still something you need to do. So it walks through that in 2 pages. So there's something there. Your point about why doesn't Social Security give more prescriptive information is because everyone's circumstances are different. And Social Security can help interpret the rules and walk you through how the rules and benefits would affect you. But they don't know your individual circumstances. And they also don't want to give you the wrong advice. Right? You don't want someone coming in and saying, look, I think I'm going to live until I'm 70 or 75. Or heck, you know what? So me personally, Paul Ramsey and TC should know this. My goal is to live forever. And so far it's working. Right. But I could get hit by a bus tomorrow, right? So if someone comes into the agency and we tell them you should delay claiming, and then they get hit by a bus, someone will say, well, they lost out on a year or two of benefits. So you gave them the wrong decision. So the idea is not to have Social Security tell them what to do. It's to walk through the process and help them make the best informed decision they can based on their own personal circumstances.
Okay, Ramsey, I thought you were going to go right for the workplace solution. I mean, come on, you got to ask some questions here. Jason teed it up for you.
That's a good one, Paul. Put him on the spot, because Ramsey, let's do workplace. I think the role of the employer is very big here. And I also bring it up in the Peak 65 here. There's a huge role for the employer now.
So go for it. I mean, I've obviously a big believer in the workplace. We talked about it on the panel last May. We'll hopefully be talking about it. Well, we will be talking about it in Vegas as a panel, and hopefully you can join us. How do you see the role of the workplace in this particular space? I think that the challenge of that framework that you just described, which is giving people the tools to make the decision. I still think a lot of people, even like super educated people, need to at a certain point be given that prescriptive advice that is based on their personal circumstances. And I can understand why the government may have limitations on being able to sort of take that next step, because it requires an additional level of inquiry, right? And at the same time, financial advisors are not available to everyone. That was another sort of key finding from the alliances, that great event that we were at last May. So the question is, is this a workplace benefit where you're given, on a best efforts basis, some prescriptive advice on what to do next, and also, again, now sort of maybe talking my own book a little bit, layering on top of that, guaranteed income solutions that are offered, in the workplace.
So the short answer is yes, and now we go into a detailed answer.
Okay.
So I think for employers, what they have to recognize is that their employees are looking to them as a trusted source of information. So all the survey work we do, and we say, who do you trust for information? You sometimes get family members, you sometimes get a neighbor. Some say I do my own research on Google, or I'm going to a news article. But by and large, a lot of the employees trust their employer for information. So the employee is looking to the employer to do this. When you ask employers, they want to help their employees. They want to create a workforce that's stable. They want them to be happy. They want them to be productive. They want to reduce turnover. So they're looking now for these employee wellness programs, which is a large umbrella term for what we talk about with retirement issues, or even helping with student loan issues or mental health issues, or even like dog walking services. Everything falls in this financial wellness category. But specifically when it comes to retirement, the employer has been reluctant in some ways to give advice because they're concerned about fiduciary liability and giving the wrong decision. What they can give, though, is information and education, and again, help people walk through the choices that they have available to them and what that means for retirement security and protected income. And Ramsey, I'm with you that even those people who are really educated, smart, need help. And what does that mean? So the next rollout I see happening for employers and plan sponsors is we need to have more protected income products inside a defined contribution plan, whether it's inside a target date fund or in the plan itself. And there should be defaults. Now, someone's going to hear the word default and get really upset with me and say, look, Jason, you've always said that one size does not fit all, and it doesn't. But you can have some scheduled defaults, keyword there being plural, that would fit for 95% of the population. And with any default, there's always an opt-out option. You got to make sure someone has an opt-out option. So if I was retiring and I walk in and Ramsey's sort of the employer, and I sit down with Ramsey and say, look, I'm going to retire next week. What are my options in the plan? And Ramsey says, we have 3 default options for taking some of your defined contribution plan assets and making that protected income. One is a lifetime annuity. One is something called a trial annuity, which you can try it out for 2 years. And if you don't like the income stream, you can turn it off and get the rest of your money back. The other is a bridge annuity. It's a default because, Jason, you're 62, and we want to make sure you can maximize your Social Security retirement benefits. So we have a default option that gives you 5 years until you turn 67. You can get the standard retirement age benefits, which is a higher monthly benefit for the rest of your life. And a little side one, if you want to go to 70, we can make it 8 years. Those are the defaults. Which one do you want? You can pick 1, 2, or 3, or you can say neither. Now you've given them information, you've given them education, and you've still given them a choice. But you haven't made it so unbearable that they have the problem of trying to figure out, what do I do? You've now given them 3 good options. And one of those 4th options is do nothing, which most people I think will do something. That's what I think the role the employer has and plan sponsors, and we redesign and tweak our defined contribution plans. What do you think, Ramsey?
So a few things. One is the reluctance to provide advice that you described for employers, remarkably similar to the one we talked about with the Social Security Administration. I think, like, at the end of the day, either somebody needs to give advice, or fortunately or unfortunately, for a lot of people, the decision needs to be made for them, which goes back to this concept of one size fits most, which is how I would sort of characterize what you described as being given something that people can opt out. And look, I don't think target date funds are perfect, but boy, they're so much better than the alternative. They're so much better than the alternative, which is probably, inaction. So one of the big findings of sort of my journey in this space, going from institutional to, focusing on consumers and retail and better understanding it, is education and financial literacy are super, super important. They don't necessarily move at the speed of need. So, like, the need for people to actually have things in place is moving faster than people can kind of become fully educated. So I think both processes need to go on in parallel. So That's simply my view, and I think that what you've outlined is consistent with that.
Okay, I have to double click on that. Education is good, but what moves somebody to act is very interesting, right? It's this. How do you get the left brain to connect with the right brain? Ramsey, Jason. It's now, again, not advertising our product, but we came out with a product where you effectively get you can dial your own income stream explicitly. There are ways to do this with products, but they're complicated. We made it a little simpler. Um, you can say, listen, I want this much income for this period, and then I want to dial this thing down. Almost, Jason, what you're describing. Okay, here's the challenge. There are our actuaries calculated 4 quadrillion options for how you set this check. So, Tisa, how do we connect? What's the most effective way to educate but then create action? Tisa, talk about the broad approaches. Jason, would love to get offline, get you to see some of these since you've focused so much, and give us your thoughts here, Tisa.
Yeah, sure. So, all different types of learners, right? People consume information differently, but the age-old saying picture's worth 1,000 words. So we've come out with some resources and educational tools and calculators that really paint that picture. So, Jason, you were talking about the advantages of delaying Social Security, for example. And it is hard if you're hitting that retirement age to envision not getting that income stream that you've thought about as your third leg in the stool for 8 years. But we have a tool that can show that, can illustrate quickly, and maybe they're not ready for the 8 years, but even just simply 3 years, right? 4 years, like just that little. And we have a product, and I'm sure other carriers have products that can help bridge those 3 or 4 or 5 years of delay. That just shows them simply the totals of what the additional income stream they could get over the years by delaying by a few years. So that's a newer tool that we have for our agents to illustrate that value.
Yeah, think of it like for somebody who's a financial planner. I can go in there. There's a screen. You're going to see moving graphs. It's slick.
Yeah.
Tisa says it's easy, but you've got to be a planner type to use this. And talk about the other. That's test number 1.
Yeah. And it has the graphs, but it also has the simple bottom line lump sum numbers. And right, like that I think is probably the easiest story if somebody's not quite ready for the complexities of 5 charts to look through, and then you can dial up or down with spousal benefit and some of the other scenarios. But that's one of the tools we've come out with. Another one we have, back to that product I talked about, is simply some checks, some visual. Here's a check we can send you today, tomorrow, later into the horizon, for your retirement income stream, and a pretty simple interface, putting in your scenarios, your ages, years until retirement, some other values, and quickly illustrates out an income stream for lifetime income, what we call early income, or that
It's a
that
check.
bridge
Okay,
income.
Jason,
But
we
it's
will send you a
visually
check
is a
after
check.
this.
Yeah.
Yeah. So, but we've getting really good feedback, and I think it's back to that idea, like I said in the beginning, not everyone's a visual learner, but seeing a check saying here's $1, and our CEO is signed in, and here's a sample idea of what it would look like on a monthly, annual, or quarterly basis, has been really effective. And then lastly, we have been working with generative AI, right? That's another hot topic, not only in our industry, but just in the world. And using that technology, combination of both education and awareness. So stepping through some of these scenarios we're talking about with videos and other tools, but we have a couple of tools that sort of scale the ability to have the conversation. So we have one that's a marketing content generator. So I'm coming in, I know what the motivations are of my client. I know what's important to them about the carrier they're going to select, whether it's service, whether it's years in the business, their stability, pick a host of values about the carrier. And then how do you want to communicate? You need a letter? Do you need a phone script? You want an Instagram post? You want a song? Um, so we've had a lot of fun. I mean, when I say we, I mean Paul's definitely kind of leading the charge here from the Gen AI perspective. But we're excited about some of the tools we have coming out, but
Yeah.
really all to be tailored, right? Because to your point, it's not a one size fits all. And a lot of the tools I've talked about, or all the tools I've talked about, are customizable, they're scalable. Use it today for one client, use it tomorrow for a different client, and really adapt to what their needs are. So
Yeah, Jason, I almost call this, Ramsey. We will put this on social media, but it's almost the green eggs and ham strategy. You know, do you want it in a plane or do you want it in a train? We're going to try to figure this one out, right? And so I don't know. What's your suspicion? Like, is it what gets somebody to make, as you say, yes, we put the papers, yes, we get the information from. What is it that really makes, like Ramsey say, yeah, I'm going to do this. I'm going to take care of myself. I'm not going to wait for somebody else to do it.
Yeah, I think there are two things that come to mind. So one is narrative framing, and the two is defaults. So let me do the defaults second, or take defaults first, because Ramsey mentioned it. I do think at some point, employers, plan sponsors, designers of these products, are going to have to put default options in, and not 40 options, less than 5. Right? Again, always have an opt-out. So I want to make sure people who are listening realize I'm not going to force you to do anything. It's like this paternalistic libertarianism we talk about, where we believe in choice, but we're going to help you try to make what we think is the best choice, but always give you an opt-out and with the education that goes with it. So we have to do that because people, I think, do need that. The second, though, is when you start talking about this, the narrative framing. So again, and I'll lead into this. When I was at Social Security, I would walk into a field office and just talk to people, right? It's amazing what you learn actually talking to real people when you get outside the bubble of Washington, D.C. And you'd walk in and there are people who are claiming benefits at 62. I said, oh, that's interesting. And you'd talk, and some didn't understand the benefit formula and that they were getting a reduction, but some actually did. Some said, no, I realize I'm taking a reduced monthly benefit, and that's going to last the rest of my life, but I'm going to be ahead for 14 years going back to the break even. And I would say, okay, great. You're 62, you're taking benefits today. And I would ask them, how long do you think you're going to live? And they'd say, I think I'm going to live till about 82. Like, okay, so you have enough money saved with Social Security to last you 20 years. They said, no, I didn't say, and they'd pause because somehow 62 to 82 did not equate in their head to being 20 years of necessary retirement income. And it was like that light bulb, like, wait a minute, but you said 62, 82, but you didn't think you needed 20 years of retirement income? It's the framing. And this goes back to the discussion about, I've been playing around with this, about the claiming age, because what I say, the exact same message, but saying it differently equates to a different response from people. So for example, when I go in to someone and say, look, if you want to retire, if you want to get age 62 benefits, you're going to get, if it's your full benefit was $1,000, you're going to get $700. So you're going to get a 30% reduction if you claim at 62 and wait until 67. If you wait till you're 70, it'd be $1,240, again, based on $1,000. So I start saying this and they start getting it. And then if I change my framing and say, anything you do before age 70 is a penalty. And so what do you mean penalty? Why is it a penalty? Well, because age 70 is the maximum monthly amount you can get. Anything below that would be less, hence a penalty. And all of a sudden, they start thinking, maybe I shouldn't be doing this today. I should wait until I'm 70. And then when I say the difference between an age 70 benefit and 62 is a 44% penalty. Do you want to take a 44% pay cut today? That changes their entire thinking about Social Security claiming. Now, is that fair of me to frame it that way? Maybe it is, maybe it isn't. But how we talk, I mean, Ramsey's like going, yes, I think it is. Because you need people to understand that they're taking a cut. And so I think how we talk about this in the framing, none of it's misleading, but you need to be open about what the choices are and what that means to them when it comes to, again, having retirement income and the protection of income in retirement.
Yeah, I think that's super important. I mean, at the end of the day, sort of behavioral elements in this space seem to trump, pure economics like a lot in terms of individual decision making. So I think that's. I know you've written about this concept of framing, right? I think it's super important. I'm actually curious. There's a lot of people that need to be aware of all the things you're talking about. So you started out this conversation talking about where things are going with the Social Security Trust. So that's Congress. Then there's also consumers that need to hear everything that that has to be said as well. Like, where, I guess, are the ears open? Is the message getting out? How do we continue to expand the message? Because I think everybody has a vested interest in maximizing the value of Social Security in the first order, and of personal income solutions in retirement in the second order. And, again, there's lots of surveys, but I'd be curious, as somebody that's out talking to people every day, whether it's politicians or whether it's consumers, are you feeling sort of any kind of groundswell of awareness in that process?
So the answer is yes, with a caveat. So what I'm very proud of is that in the last decade plus, the narrative framing from the financial press. So when I started Social Security, if you did a Google search back then on when to claim Social Security, 95% plus of the articles written said take it at age 62 because you'd be ahead for 14 years. It was the break even. Now I think we're at 98 to 99%, say it's a personal decision. And if you can afford to delay claiming, you should. We've made that change in a decade. I'm proud of that.
That's a huge turnaround. That really is. That's huge.
Amazing.
Yeah.
And you can start seeing while age 62 is still the modal age for claiming benefits, the percentage is declining and more people are delaying, but it's still the modal age. We still have work to do. We've also changed the framing now on annuities, right? You basically went out and someone said, if I asked somebody 10 years ago, would you like to have a paycheck for life? They said yes. Would you like to have a personal pension? They'd say yes. Do you want to make sure that you cannot live your savings? They'd say yes. If I said, do you want an annuity? They'd say no. And they didn't realize, again, that what I just asked them was giving them an annuity. They didn't realize Social Security is an annuity. We have now changed the framing. And except for some I want to watch my words carefully. Except for those in the financial community who have a vested interest in not supporting protected income strategies, like a Ken Fisher or something, I think we've changed the narrative now where the financial press is saying, how do we talk holistically about protected income strategies and retirement income strategies, which could include annuities, drawdown strategies, other types of issues? That has now changed in the last 5 years, that we're having a holistic conversation about retirement income. And when I talk to members of Congress and the media now, they now get that we shouldn't just be talking about Social Security. We shouldn't just be talking about your defined contribution plan. We shouldn't just be talking about your personal savings or your house. We need to talk about your retirement ecosystem and how all this fits together to make sure that you have a financial secure retirement that includes assets that can grow, so access to the markets for inflation protection, and protected income so that you have a license to spend and you don't spend too little or spend too much in retirement. And we start talking holistically, everyone seems to get it. And it gets you away from saying, well, I just want to shore up Social Security. Or, and now we're trying to defend people who are saying we should get rid of the 401k system, which is ridiculous because we've had so much success getting people to retirement with a 401k plan. Does it need tweaking? Yes. Do we need to do a better job getting more people access? Of course. Does that mean we should throw the baby out with the bathwater? Hell no. Right? So when you talk holistically now, we get more people in the room, Republicans, Democrats, advocates, et cetera, and trying to talk holistically about retirement security is a much better way to do this.
Yeah. Well, Jason, I love that bipartisan is in the name of your organization. So, hopefully once we get through this election cycle, we'll see a little more people jointly focused on addressing some of these issues over the long term. Listen, I want to thank you for your time. We're right at the top of this. How do people find your report?
So if they just Google Jason Fichtner Peak 65, that'll do it. Or they can go to protectedincome.org, which is the Alliance for Lifetime Income's webpage, and then search Peak 65 there. It'll pop right up. But we've gotten a lot of good press from this. I appreciate you having me on. The Wall Street Journal did 2 or 3 reports or articles on this in January and February. There's a video of me talking about Peak 65 in the Wall Street Journal as well. So we're getting a lot of attention, which is very nice. And I think it's also important to realize why now? And again, because we have so many people reaching that Peak 65 moment, this is resonating. People are trying to figure out, to Ramsey's point, where do I find help with this? Where can I go seek information to make sure I can get some sort of retirement security? The silver tsunami is here, and people are interested in this, and this topic's very lively. And we do have a few windows. This is not just a snapshot for today. We have to make sure that we put retirement security policies in place in the next few years, one for the current generation, but also as we're ending this up, think now, we're talking about Peak 65 right now. This is also a very interesting year because we're also now at the peak millennial year. where the millennial generation is hitting their peak year as well. So you've got these two peaks, if you will, that are roughly 30 years apart. So the retirement challenges we're seeing today are going to be in some ways similar or more magnified for the generation that's 30 years behind us. This affects them too. So we got to think more about this as not just being an age 65 moment. This is a retirement security income challenge for multiple generations that we have a few years to solve.
I noticed you forgot Gen X in there. What about us?
No, we're all part of it, right? But we're all going to play in some way. But it is interesting to see demographically the peaks,
teasing.
right? The peak 65, peak millennial, and the folks in between. But I think the point is when you hear one of the policy conversations, you still have a younger generation. I'll use younger saying, let's say everyone below 60 or 55, saying, why should I care about the boomers? Yeah. Why should I worry about them? They're the ones who are retiring today who are going to need the income. But that same challenges are going to face, in some ways even greater, for the younger generation today. Because imagine we get to 2031 to 33, and we're talking about Social Security reform. If it's a 50-50 split between tax increases and benefit reductions, who's going to end up paying for the majority of that burden? The millennials, Gen Z, et cetera, because they're going to pay higher taxes and get lower Social Security benefits. So this impacts them too. So they got to be part of the conversation.
Well, this is great. I don't know. Ramsey, Tisa, thanks so much. Jason, this was great again. Hope you can join us out for Retire Tech in Las Vegas, April 8th through 10th. We'll put links to your report in our show notes. And want to thank all our listeners. Keep giving us feedback, and definitely tune in next week for another great episode of That Annuity Show. Thanks.
Thanks for having me on.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.